Thank you, Madam Speaker. So Canadians pay taxes when they earn a paycheck, when they buy a house, when they own any property, when they spend money, and of course, even when they die. So it does feel for the average Canadian that there's no way to avoid the taxman unless, of course, you're wealthy enough to set up an offshore tax haven. And so Canadians were shocked to learn that the Prime Minister once chaired a pension fund that was deliberately based out of Bermuda, which is one of the world's top tax havens, to avoid paying the same taxes that every Canadian family would have to pay. Could you please explain in plain terms what a tax haven is, why corporations use them, and what challenges the CRA faces when trying to collect taxes from entities that operate in Canada but shift their profits abroad?
Sure, I'll start on that one. So tax haven is a term for a jurisdiction that imposes low, minimal, or no income tax, often corporate income tax, but can be personal income tax as well. Sometimes it's a special regime that's available only to foreign entities with the objective, occasionally, of attempting to attract investment income from other countries. So that's kind of a definition of a tax haven. You asked, and just to get your question clear, you asked about challenges the CRA encounters.
Why corporations use them, and then the challenges.
Why corporations use them. In my experience, corporations generally are motivated to return profits to shareholders. That's their bottom line objective most of the time, is to benefit shareholders. And so they look to provide the highest after-tax return possible. So they're looking for low tax rates. That's a reasonable objective for business people. Our challenge at CRA is to make sure that profits attributable to Canada are properly reported in Canada, and that profits that belong to other countries, such as important trading partners like the United States and the Europeans, Japanese, Koreans, that profits earned in those countries can be taxable appropriately in those countries as well. So we have some tools. Currently, we use transfer pricing rules consistently with other countries that require that intragroup transactions occur at arm's length prices, so really at commercial terms within a multinational group across its supply chain. My colleague Trevor mentioned the foreign accrual property income rules. So Canada has a policy of requiring that passive income that's earned offshore by Canadian multinationals and Canadian high-income individuals is taxable on an accrual basis in Canada as a general matter.
May I ask a follow-up question? Would you agree that ordinary Canadians don't have the luxury of setting up these complicated offshore tax havens, or tax structures, rather, in countries like Bermuda to avoid paying taxes? Because they're not simple structures.
There are certain transaction costs that have to be taken into consideration for offshore structures.
Mm-hmm. So would you say that ordinary Canadians would not have the luxury to set those structures up then?
I think that's fair.
And would you agree that when high-income individuals or corporations move taxes offshore, the burden doesn't actually disappear, that it actually shifts onto the shoulders of working Canadians who don't have access to these schemes?
I guess the CRA is very active in applying Canada's tax rules to ensure that all Canadians are paying taxes appropriately under our laws. We have a lot of good new tools, and we're experiencing a lot more success than previously. So I guess I would just say it's not the case that rich people can simply shift funds offshore and avoid detection and avoid the law.
And, I mean, you explained that there are transactional costs to setting up these structures, right? In other words, you have to be able to afford an expensive lawyer, an expensive accountant to be able to set them up. And that oftentimes is not accessible to an ordinary Canadian. So on that basis, then, these structures are not available to ordinary Canadians. It's only to the wealthier.
Thank you, Ms. Kobina. That's your time.
Okay, thank you, Chair. So in 2018, the Auditor General identified offshore transactions as highly problematic. The Auditor General pointed out that with regular Canadians, small business owners, ordinary taxpayers, when the CRA would request a receipt or information to support a claim, the tax filer had 90 days to comply, and then the taxes would automatically be assessed in absence of production of the document. However, for other taxpayers, such as those with offshore transactions, we found that the time frame to provide was extended for months or years. So it was the Auditor General's finding that offshore filers are given a break by the agency, that after months or years of non-compliance with requests for information, taxes would simply be waived. I asked Commissioner Hamilton about this at a more recent meeting when he was here in December. He didn't have any answer to my question about whether or not there has been real progress made. Can you tell me how do we now have an even playing field between ordinary Canadian tax filers and offshore tax filers, or those with offshore accounts?
Alors, Madame la Présidente, je vais commencer la...
Madam Chair, I'll start the response and then I'll give the floor to my colleagues who are specialists in verification. We do not manage those files the same way, but we make sure that we are fair in the management of those files. Some tax filers are better equipped than others to respond to our questions, and we consider them when we are giving them deadlines. Now, the deadlines could be longer with some tax filers, but we try to be as fair as possible. But let me give the floor to my colleagues, maybe Adriana, who will complete the answer and tell you how we carry out checks.
Thank you, and thank you for the question. It's true that the OAG review did reveal that there appeared to be some inequities between the treatment of the taxpayers in certain categories. There is an acknowledgement that the offshore transaction audits involve complex arrangements that require extensive information gathering activities. That does necessitate more time for the auditors to obtain that information.
Okay,
that said,
if I may, I'm sorry. There was quite a bit of time there for a response without an answer, which is do we have shorter time? So I'd like to skip through and just get you to answer this question. The recommendation was accepted by the agency, and that the agency should set time limits around these audits. Are there limits? What are they? And how short are they? What's the gap between regular tax filers who have 90 days and offshore filers?
Thank you. So since that report, we did publish a communique to all of our auditors, and it is available online, that standardizes the timelines around audits. It has dates, timeframes associated with information requests detailed in that communique.
So they get more than 90 days?
It's a 30-day time frame, and there are extending circumstances where timeframes may be lengthened if the situation warrants it.
Okay, thank you. So the Brookfield Asset Management, under the management of the current Prime Minister, when he was there, he oversaw the creation of 3 funds: Brookfield Global Transition Funds 1 and 2, and the Catalytic Transition Fund. These funds were domiciled in 2 in Bermuda and 1 in the Cayman Islands. Are these locations tax havens?
Madam Chair, we cannot discuss the files of individuals, unfortunately. My
question was, are Bermuda and the Cayman Islands tax havens?
I think it's reasonable to call them low or no tax jurisdictions.
Okay, thank you. And how much does the use of tax havens by large companies cost Canadians in lost revenue?
Madam Chair, It's difficult to answer that question because we carried out some studies, even some at international level, to determine the gap between taxes to be paid and those actually paid by the taxpayers. The agency has already published a report on the gaps between the taxes to be paid, and the last study was in 2022. At the time, it was about $1 to $3 billion as a tax gap, but that's an estimate that is based on many theories. It is difficult to give a figure.
Today, does the Canada Revenue Agency now give the PBO access to the information that they have long requested and has been refused by the agency so that they can measure the tax gap? And I'm not talking about macroeconomic data. I'm talking about the actual tax information that successive PBOs have requested from the CRA.
Thank
do
you,
now
Mr.
cooperate?
Kelly. That's
They've got
your time.
10 seconds, I think.
Nope, that was it.
Mr. McGowan, first of all, forgive me. My colleague Jean-Denis is an economist and is usually here, so I'm not a specialist like him. So I hope my questions will not be simplistic. To start, seen from outside, when we talk about tax avoidance or tax evasion, we have the impression that there's an imbalance. The average taxpayer has difficulty finding tax havens, whereas the agency and department are looking into ways of maybe facilitating the life for multinationals or speculative funds.
Moi, je regarde au niveau de l'évasion.
When I look into tax evasion, there are many sources giving us the impression that the mechanism that you have introduced that helps multinationals to repatriate funds to tax havens without paying taxes on the principle of double taxation. I think there's a regulation in force in that regard. For the ordinary person who doesn't have tax and economic know-how, this seems to be a mechanism that helps to avoid non-taxation. I would like to understand. Please explain this to me. The Regulation 5907 that helps to repatriate funds. If the department wrote down that regulation, I believe that there's an advantage, and I would like to understand the advantage for the ordinary taxpayer to have that kind of regulation. Thank you for the question. I will answer in English because I need to be very precise with the terminology.
I think there were three issues raised. First is the distinction between tax evasion and tax avoidance. Tax evasion is, of course, a crime and dealt with largely through information sharing. Tax avoidance is the legal avoidance of tax, and where it is aggressive or inappropriate tax avoidance, then typically the government responds and tries to shut it down. The question, of course, is absolutely correct and I think insightful. There are greater opportunities for international tax avoidance depending upon the size of the enterprise. That is, for example, part of the reason why the Pillar 2 global minimum tax, which would serve to impose a minimum tax rate of 15% on all of the companies within a multinational group, regardless of what country they're in, apply only to the largest multinational organizations. So those with gross revenues in excess of 750 million euros. And so those rules apply to the largest companies, both in response to the fact that they have the capacity to bear the additional compliance burden, and also out of recognition that they do more of this type of planning, and it would provide the greatest impact fiscally. And finally, in terms of the specific regulation mentioned, I believe the question relates to our exempt surplus system. That is a set of rules within the Canadian income tax system that allow active business income earned in a treaty or tax information exchange agreement country to be repatriated to Canada tax-free. The policy underlying that set of rules is that it allows Canadian businesses to compete on a level playing field with their competitors in foreign jurisdictions. So if there's tax imposed in the foreign country on that active business income, then that is the tax that applies. And it's called a territorial system, where Canada does not tax, or we tax our companies on their worldwide incomes, but active business income earned in our treaty partners and TIA, or tax information exchange agreement partners, can be repatriated tax-free. That allows for a level playing field and a separation of taxing rights between Canada and other countries. Finally, I think it's important to note that that applies only to active business income. It doesn't apply to passive income. So those are the kinds of passive investment returns that can be more easily shifted to a foreign jurisdiction. And those are taxed on a current or accrual basis in Canada under what are called our foreign accrual property income rules. So the effectively tax-free repatriation applies only to certain active business income from foreign affiliates. So I hope that answers the three parts.
Merci.
Monsieur Simard, vous avez...
Thank you. You have 5 seconds left, Mr. Simard. Thank you.